Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on this afternoon's market action. We've got about an hour to go in the trading day. You're looking at losses across the board. The losses that we're seeing in regional banks really setting the tone for today's action. That route keeping the broader market in check. You're looking at losses across the board. Most of the S&P sectors in the red this afternoon. The worst performers, financials, communication services, and industrials. Also the VIX, the fear gauge index, spiking above 20. But let's get you up to speed on that sharp sell-off that we are seeing in regional banks. Shares of PacWest and Western Alliance tumbling today on fears that another lender could potentially fail. Yahoo Finance's Diane King Hall has that story for us. Hey, Diane.
Yeah, hey, right, Shauna. A lot of pain in the regional banking sector. In fact, more today. PacWest shares under so much pressure. The stock was halted for volatility multiple times today. You're looking at it down more than 40%. This after the lender announced it is exploring its options, including a potential sale. Now, PacWest is a mid-sized lender that caters to small and VC-backed businesses. That may sound similar to SVB, but PacWest's financial picture differs from the recently failed regional banks. PacWest says it has seen core deposits increase since banking turmoil kicked off back in March. Now, deposits at the institution totaled $28 billion as of May 2nd, which is near April levels. So it hasn't seen a massive client outflow. It is clearly speaking out, trying to reassure investors, but that message certainly not coming through in terms of the stock performance today.
And Diane, you talk about PacWest being halted. We saw Western Alliance shares also being halted on those reports. They're exploring a sale. The bank, though, denying that. What's the story?
Yeah, they are. So that stock is under heavy pressure, as you saw earlier when we popped up the graphic on that. It's under pressure as well, down more than 30%, taking another leg down. It's off its lows of the session. It is denying reports that it's exploring a potential sale. It says the report in the FT, the Financial Times, is, quote, categorically false in all respects. The bank says it is, quote, not exploring a sale, nor has it hired an advisor to explore strategic options. Now, you see these trends happen with regard to the stock price. Selling begets more selling, and the chatter around problems in the regional banking sector almost becoming a self-fulfilling prophecy. Now, we heard Fed Chair Jerome Powell speaking out yesterday, talking about him seeing stability and thinking that the troubles in the banking sector, the regional banking sector, have stabilized. But that is not coming through in terms of what we're seeing with regard to the regional banking sector, whether we're talking about these individual banks like PacWest, like Western Alliance, or just looking at the regional banks in general. The index there is down as well. The KRE index down 5% on the day right now. But Western Alliance does have a better balance sheet than we've seen with, say, First Republic or SVB. But right now, it's just like it's a confidence game. Bill Ackman tweeted about this today, saying part of the issue with regard to the banking sector is confidence. And there is a lack of confidence right now within the banking sector, particularly, obviously, within the regional banks. And of course, you also had JP Morgan Chase CEO Jamie Dimon out earlier this week trying to say that there was stability within the sector, not playing out today.
Yeah, I mean, you have everybody weighing in on this, including Jerome Powell. The market's certainly not believing it. In part, that speaks to the credibility issue as well, but certainly a story we're going to continue to follow there. Thanks so much for that, Indeed. Diane. Well, now let's get you up to speed on a wild day for oil. Crude climbing from sharp losses earlier in the day and closing almost unchanged, but it is still under $70 a barrel. Earlier in the session, prices hit their lowest level since December 2021. Oil prices coming under pressure over recession fears, which would, of course, impact demand. But there is another factor at play here. Investors are watching Russia's oil supply, which is reportedly seeping into the market. And Shauna, you look at where the prices are right now. In the Asia session, it would inch closer to $60 a barrel. So we are seeing a steep sell-off here. I mean, not surprising on the one hand when you think about what we heard from Jay Powell yesterday. There are concerns about the economy heading into a recession. But the Russia factor really continues to be a big X factor here. You'll recall Russia agreed to cut their output as well. Certainly the market not believing it because that supply is still coming online.
Yeah, the flows from Russia certainly seeming to be much more resilient than many had initially anticipated. But I think you're exactly right. It's a multitude of factors right now that's weighing on the the price of crude. So you got the supply coming from Russia. Also just the fact that we'll likely see a more intense economic slowdown here in the coming months, and exactly what that is going to do for the price of oil remains to be seen. And it was just 6 weeks ago when there was a lot of talk about that the price of crude was going to continue to the upside, given the fact that OPEC Plus came out and said that they were going to continue to cut production. Right now, we are looking at a totally different scenario with the price of crude back below $70 a barrel, and more people on the street, more people that are closely watching crude saying it's going to take quite some time to get back to that $80, $90, or even $100 barrel. We won't see that maybe anytime soon.
Yeah, worth noting Russia's deputy prime minister weighing in on all this, saying, look, this idea that Russia is bringing more online simply isn't true. They are committed to those cuts, but of course we need to watch that closely to see if in fact they follow through on their word. Well, Johnson & Johnson's consumer health spinoff Kenvue is officially going public on the New York Stock Exchange today. Kenvue will now be the company behind brands like Tylenol, Band-Aid, and Listerine, trading under the ticker KVUE. Shares were priced at $22 a share, and now you're seeing it up about 20% almost here on its initial day. It is the biggest IPO in more than a year. And we've got Yahoo Finance's Anjali Kamlani on the floor of the New York Stock Exchange with Kenvue's CEO. Anjali.
That's right, Akiko. I have here with me Thibaut Mongeau, who used to head J&J's consumer segment and is now sliding into the CEO position of Kenvue. Thibaut, thank you so much for joining us today. Obviously, a really lovely start for you for the stock. More than you expected, I imagine?
No, thank you for having me. We are very excited today. It's a great day. We just listed Kenvue for the first time, bringing it to life as the world's largest pure-play consumer health company. $15 billion in revenue, presence in 165 countries. So today, millions of consumers have in their house a Kenvue brand. Think about Tylenol, Neutrogena, Band-Aid, Listerine, Aveeno. These are brands that have been with consumers for decades and sometimes for generations. And we are happy to bring Kenvue to the world today and make sure that we are excited about today, but also what lies ahead. Absolutely.
To your point, brands that people know very well. The company already valued close to $50 billion based on the IPO right now, largest this year. Really good start for the brand. But talk to me about separating from that legacy J&J brand, which is what these consumers know, and about how Kenvue now fits in this new consumer health market.
Yeah, we do this from a position of strength. Kenvue has strong leadership positions across the different categories where we play. We are the only company our size covering all aspects of consumer health, self-care, skin health, essential health, but with a depth and expertise that we have because we have been in this space for 135 years. So that's what really makes Kenvue unique, and that's what makes us very confident in our ability to thrive as a publicly traded company.
How does it fit into the broader market? We know that GSK, for example, spun off Haleon, and so there's examples of this, and they've been performing pretty strongly as well, quarter over quarter. How do you think about investment, innovation, and the like when it comes to Kenvue moving forward?
Yeah, we are very pleased with the portfolio we have. We are very well positioned in the categories where we play, but also the unique portfolio of iconic brands we have at Kenvue, and we see ample opportunity for our brands to continue to grow, to continue to innovate, so we can bring to consumers a product and solution they need to take better care of their health. And that's really our mission at Kenvue.
Almost like you're separating from the company, or like a 16-year-old being given the keys to the car and you get to just take off, right?
Yeah, 135-year-old, 16-year-old. But yes, we are going to be more focused with more agility, really being able to focus on our mission to be close to our consumers and understand how we can innovate to better serve their needs.
And I know this is just a starting off point. You obviously have build out. J&J still holding a majority stake in the company for the rest of the year. You're also building out a new space, a new headquarters. But in terms of looking at old J&J, there's also the talc situation, the litigation there. You have the product coming under this new consumer brand, but you are indemnified against the case. Talk to me about the baby powder and baby products moving forward and the plans for them.
Yeah, let me be very clear. This liability in the US and Canada stays with J&J. So at Kenvue, we are laser focused on what we do best, building brands that have a strong trust and leadership position with consumers. That's where we are focused on right now. And we continue to evolve our portfolio to more natural, sustainable solutions. And that's what we will continue doing moving forward.
Tell me about the read on the market for consumers. What is it that you think they're looking for when it comes to the outlook of the brand development, of what types of products you're looking to introduce? Anything new on the horizon?
Yeah, there is no limit for you to take care of your own health, and there is no limit for Kenvue to invent products and solutions that allow you to do that. So this summer is coming. So if you take sunscreen as an example, unfortunately, millions of Americans do not use sunscreen on a regular basis today. So that's something that we look at Kenvue. Our Neutrogena teams did step up and launch innovation with a new product, Neutrogena Invisible Defense, that doesn't leave any residue on your skin, whatever your skin tone. And so that's going to be a great new reason for Americans to reconsider sunscreen and have a great summer thanks to Neutrogena.
I may or may not be one of those people that skips out on sunscreen sometime. Okay, so final question for you. Going forward, you taking over at the helm of the company, is this a long-term takeover for you? Do you imagine you're going to be with the company for quite some time? Because you've already been with Legacy J&J, you've overseen the growth of the consumer business through the pandemic and everything. How do you feel about going forward?
We are very excited today, but also about the future, what lies ahead for me, but also for the 22,000 team members who around the world work every single day to make sure that they help consumers realize the extraordinary power of everyday care, that bring them products and solutions that are grounded in science, endorsed by doctors, healthcare professionals, help them take better care of their health. That's what we are focused on at Kenvue, and we are very excited about it.
Love it. Well, Thibaut Mongon, new CEO of Kenvue. Congratulations on the IPO today. Shauna, back to you.
Great stuff, Ange. Great interview. Thanks so much. Kenvue shares up 20% today in their public debut. All right, well, we are just getting started here on Yahoo Finance Live. Coming up, Airbnb unveiling a series of changes to its platform, and the company's CEO Brian Chesky sat down with Akiko and Brad Smith to explain why. That conversation later this hour. Plus, Reddit co-founder Alexis Ohanian speaking out on artificial intelligence with our own Ali Garfinkel, saying that it's the biggest development in technology in his career, even bigger than the smartphone. You won't want to miss that interview. And Apple earnings set to report after the bell this afternoon. We will have those numbers for you as well as analysis. And also be sure to tune into After the Call with Brad Smith and Diane King Hall around 6 p.m. Eastern Time tonight. We'll be right back. Regional banks selling off once again today as investors worry about another potential bank failure. The move lower coming despite comments that we heard from Fed Chair Jay Powell yesterday in his efforts to calm banking sector jitters.
The U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress.
So on helping things today, we want to bring in Tim Coffey, Janney Montgomery Scott, Associate Director of Depository Research. Tim, it's great to see you here. So, of course, the big news today that's leading the declines is PacWest coming out saying that it is exploring strategic options. You also have Western Alliance off more than 30% today. You've reiterated buys on both of those banks. Why?
We did. Well, we think there's a disconnect between the stocks and the underlying companies right now, right? So last night, both companies came out and said deposits are stable to growing, capital is growing. You know, those are both really good things because they show the strength of both institutions. But there's stuff happening in the market right now on their equities that lead people to get the impression that maybe they're not so good, when really what's happening is they're good. So what we're seeing is lots of put activity right now, which is suppressing the stock prices. Lots of trading in the aftermarket hours, which is typically a very thinly traded market to begin with. And then, of course, you've got what's already happened with First Republic and Silicon Valley Bank, and that's giving people the jitters. And I think that we, as kind of investors, especially in the bank space, there needs to be a separation between church and state. The stock is not the depositors, and the depositors do not reflect the stock price.
So how do investors kind of wade through that? I mean, when you think about where things are, to your point, everything's kind of getting lumped in. You look at the regional bank ETF, I mean, that was down about 5% today. Certainly not the kind of bloodbath we saw earlier this week. But investors are looking at every one of these regional banks saying, who's going to be next? So how do they differentiate that?
Well, they need to consult the disclosures that the companies are putting out. And they're putting out a lot of disclosures, right? We've got call reports, earnings releases, 10Ks, 10Qs. Right now we're getting mid-quarter updates where we're basically every 2 weeks, some banks are telling us what their deposit flows look like. And you have to analyze those. You actually have to read them, right? So at Western Alliance, for instance, deposits are going up, right? The problematic depository customers in the technology sector that they experienced in March, they're bringing deposits back. They're up about $400 million since March 20th. You're seeing more borrowings and more on-balance sheet liquidity within the entire banking sector. You're seeing more cash on balance sheet. You're seeing deposit costs starting to go up. And so what we actually have across the industry is a banking industry that is more liquid and more attentive to customer demands when it comes to deposit costs. In a lot of ways, banks are safer right now than they were at the beginning of the year, but it's hard to really kind of acknowledge that reality when you've got declining share prices, on the screen every day.
Tim, why do you think PacWest and Western Alliance are being targeted so specifically?
Because they're the last of the four from the Silicon Valley Bank closure, right? So they all Silicon Valley Bank obviously had exposure to the VC and private equity industry. So did First Republic through their high net worth business model. But Western Alliance has a small subsidiary in Silicon Valley, and PacWest was also doing business in that same area, the industry rather. And so when you saw the run on deposits at Silicon Valley Bank, close the bank, that's how severe it was. Same thing happened at First Republic, right? And they had to do the resolution with JP Morgan stepping in. And then you saw also deposit declines at Western Alliance and PacWest. I think it's interesting that you're not seeing this in other parts of the country, right? It was very abrupt, very quick deposit run on four institutions, all around the Silicon Valley area. You're not seeing this in other parts of the country.
Going back to Western Alliance and PacWest, so, I mean, you just pointed to the numbers that we've gotten from the company. I mean, things may look fine now, but it isn't the fear, at least among investors in the market, that things could really change on a dime. Some would argue that SVB wasn't necessarily in a bad position, but because of digital banking, because depositors could get to it so quickly, things really accelerated very quickly. Isn't that the larger fear?
Well, I think the larger fear is we just haven't seen a classic bank run in a while, right? And that's what happened at Silicon Valley Bank. Yeah, it was done in unique ways and in a very modern way, but that's all it was. And we're not seeing that, say, at a Western Alliance, right? What's happening at Western Alliance is their deposits are actually increasing, right? They're on target to grow deposits by $2 billion this quarter. They've increased the percentage of insured deposits to the point that if they were among the group of 50 largest banks in this country, they would be in the top decile in terms of insured deposits. And on the uninsured deposits, they've tapped enough liquidity to cover that amount by almost 170%. Right. So I get, that there's this perception of fear because we've already seen, 3 banks closed, one decided to close down itself. But the reality of the situation, the fundamentals and the information we're getting from the companies like Western Alliance is that that's just not the case. These are much better institutions than the stock prices suggest.
But Tim, there certainly is a lot of fear out there among investors. What is the risk or the likelihood maybe that another bank will fail, even outside of PacWest and Western Alliance, if you think those business models, those fundamentals are still strong?
Well, I think across the industry, we're going to have losses in the bank sector, losses on credit, not necessarily banks. Because one, we've got more capital in the industry than we have in the last 15 years. Banks have been lending with lower leverage than they have in the last 15 years. So for instance, commercial real estate, it's not unusual to see loan to values in the 50 to 60% range, whereas 15 years ago, it might have been in the 80% range. So banks have a much bigger capacity to withstand losses. The things that we've seen so far have been liquidity related, the customer related, where 2 institutions specifically have lost the confidence of their customers. We haven't seen that broad based.
Tim, Coffee with Janney Montgomery Scott. Appreciate your time today. Good to talk to you. Well, coming up, layoffs have been racking up in the media industry. What it says about the business of news, we're going to be discussing that on the other side of the break.
No fear of missing out and sometimes just being plain boring. It's what made Warren Buffett one of the most successful investors in history. In fact, anyone can invest like Warren Buffett. His strategy is centered around the principle of value investing. Finding companies that are undervalued, focusing on long-term earnings, not short-term growth. In other words, buy businesses, not stocks.
If we buy a business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year some year. We care a lot about the price. We do not care about the next 12 months.
Batteries and paint. Not sexy companies, but guess who owns Duracell and Benjamin Moore? Buffett's Berkshire Hathaway. Buffett invests in companies that have a competitive advantage, or a moat, as he puts it. It's what led him to invest in Apple, his biggest holding.
I just think of basically the utility of those products to a ecosystem that is demographically terrific and finds that instrument useful in dozens and dozens of times a day. It's almost indispensable, not only to individuals, business, everything.
Buffett also invests in companies that are easy to analyze. He knew the value of the membership subscription model long before Amazon Prime or Netflix. Berkshire has held Costco for decades.
Buffett says he buys what he knows, which is why Berkshire is the largest shareholder in Coca-Cola and Kraft Heinz.
Does his approach cause him to miss a few big winners? Sure.
He passed on Tesla and Google and was very late to Apple and Amazon.
The fact that you're missing out on 90% of the stuff doesn't really make any difference if the 10% you do is right.
He's always had a penchant for banks and insurance companies. Berkshire Hathaway owns Geico and has stakes in Citi, Visa, and American Express.
To invest like Buffett, buy what you know. Buy a business, not a stock. Don't be afraid to be boring, and be patient.
Well, economic challenges have forced a slew of companies to make tough decisions this year, including several news and media outlets. Disney, BuzzFeed, an insider among those making staff cuts, while Vice reportedly close to filing for bankruptcy protection. Joining us now is Ben Smith, Semaphore editor-in-chief and author of the book Traffic, which, by the way, hit shelves earlier this week. Ben, it's good to talk to you. Really fascinating topic here. Certainly makes sense for you to be. You were at the center of a lot of these media deals that you specifically address in the book. But I'm curious to get your take about the media landscape right now? We just highlighted some big changes that are happening with the big media companies, but also these upstarts, the disruptors, not necessarily churning out the way they used to. I mean, what do you make of the shakeup that's happening across the media landscape right now?
Yeah, I mean, I think, thanks for having me on. And it's obviously a tough economic moment for a lot of companies. And so you're sort of seeing layoffs, seeing, difficult choices for that reason. But I mean, the biggest picture for digital media really particularly is just that these big bets on a certain kind of internet business that was based on traffic, that was based particularly on this huge surge of traffic that came from Facebook and from social media, that the world has gone in a different direction. And that companies that were particularly that placed these huge bets on the social web in the 2010s, like BuzzFeed, where I was, and that, that reached enormous numbers of people and built huge brands. First, we didn't find we could build businesses on top of Facebook, and then watched as Facebook started to decline itself, the app, and turned away from news entirely.
So Ben, clearly you don't think those models are working as effectively as they had been over the last decade or so. So what does that mean as to what is working now? And how does Twitter and the landscape there and the changes that Musk has implemented, how does that play in the future of media, if at all?
Yeah, I mean, Twitter had kind of been the beating heart of news and a great place to go if you just wanted to know what was happening in the world. Now, if you look at Twitter, you find out what is happening at Twitter, which is often hilarious and interesting, but kind of a different thing. And I think a lot of consumers, I mean, I'll speak for myself as a consumer, feel really, really overwhelmed by the amount of incoming, but unsure of what to trust. And I think a lot of what's new are outlets where they're putting trusted individual journalists forward, and where they're trying to distill a lot of the many, many sources out there for consumers who feel really just sort of unsure and shaken by just the amount of incoming, by the chaos on social media.
I mean, that leads us to your latest venture. You started Semaphore, and I have to wonder, just after your experiences in other media outlets, why you started Semaphore and what it is about that model that you think is going to work in this environment.
Yeah, well, I've been the media columnist for the New York Times for a couple of years, sort of throwing stones at other people's glass houses. And, it's interesting when I went back to write this book, Traffic, like I sort of saw this moment of massive change in the early 2000s when people were very unsatisfied with the media market. With the media they were getting, the news they were getting, were looking for something different. And this is a very different moment, but it does have that in common. If you go out and ask people, like, do you love the news environment? Do you like what you're getting? Do you feel like it's helping you understand the world? People really say no. And I think that is an opportunity to try to focus on solving those specific problems for people.
In the title of your book, you talk about the billion-dollar race to go viral. A lot of that, though, plays back to what happens on social media. So if we're kind of moving away from being so reliant on social media, what is that, race to go viral or to get consumers' attention? What does that then look like?
I mean, it's so different. It's so weird for somebody who did kind of come up in that social media age. I mean, I think things go less viral now, and where it used to be everybody was on one or two platforms talking about the same things. Now people are listening to different podcasts, reading different newsletters, not necessarily in agreement on even what is the biggest story in the world, much less what to think about it. It's a much more splintered environment. These companies like BuzzFeed, like Vice, took hundreds of millions of dollars of investment. And I think we thought we were kind of racing to a kind of huge scale. I think for Semaphore and for other companies, we're trying to begin by really finding an audience we feel very directly connected to, but I think aren't under the illusion that it's going to all happen quite so fast.
Yeah, I mean, you talk about that splintered environment. It certainly does feel like increasingly, we've got, I can't count how many newsletters I get in my inbox in the morning. We're choosing who to follow. We've got
8 of them
trusted
are from Semaphore.
I don't know about 8 of them. One of them is from Semaphore for sure. But you talk about this age of disinformation. There's so much distrust within or among media or within media. I mean, how do you restore that trust if it feels like readers and viewers, if you want to broaden it out, are kind of in their corners right now?
Yeah, and I don't think it's something you can wave a magic wand, right? like there's been declining trust in institutions all over the world and institutions of all sorts. So this isn't something where like if you just did slightly better journalism, you would reverse this like 50-year global trend. But I mean, our experience is that people want to hear from individuals who, and who also are pretty careful. And we are very obsessed with distinguishing the facts from our point of view, our opinion, and bringing in points of view that disagree. And I think to try to say, look, there's some level of shared facts that we can agree on, even if we're not expecting everybody to agree on all the interpretations and all the narratives.
Ben Smith, author of Traffic, also founder of Semaphore. Great to have you on today.
Thank you, yes.
Well, one of the biggest threats facing pretty much every company is cyber attacks. As the threat grows, companies now more than ever need to be on their toes to protect themselves. It's something Yahoo Finance asked Betsy Atkins, who sits on the board of Wynn Resorts and GoPuff, about at the annual Milken Institute Global Conference. Take a listen.
It's interesting, the rate of attacks. I think that your audience, I was shocked. KPMG, the Big Four accounting firm, says that there were 62% of all public companies had a breach. 62%. And when you look at the types of breaches, still 93% comes from phishing and social engineering.
Very basic stuff.
Right? And so training your employees, it's harder because the spoofing is more sophisticated. And with generative AI, I'm horrified at the exponential weapon we put in the cyber criminals' hands at doing better impersonations. So I think that the focus needs to be in training and prevention, but critical, you need to look at how can you recover post a breach.
All right, coming up, we are counting down to the closing bell and checking in on some of the trending tickers this afternoon. You're looking at gains for Shopify of 26%, Paramount losses at 26% as well. We'll discuss when we come back. It's time for a triple play. 3 stocks that we're watching in the final half hour of trading. We've got Shopify, Paramount, and Royal Caribbean. Kicking it off with Shopify announcing a big strategy shift today. The company is also cutting 20% of its workforce and selling the majority of its logistics business to Flexport. Now, the deal is getting the support of Wall Street, with Citi calling it a, quote, friendly deal, and Baird writing in a note to clients that it, quote, sets up the company for long-term success. Now, as part of this agreement, Shopify will get a 13% equity interest in Flexport and a seat on its board. Shares today are surging up just about 26% in intraday trading on those cost-cutting measures, the deal, and then also its stronger than expected first quarter results and sales outlook, the biggest intraday pop that we are seeing in about 7 years at Kiko. So lots of excitement from the number of announcements that we heard from Shopify over the last 12 hours or so.
Yeah, when you talk about what they mentioned on logistics, that is quite the reversal. When you think about Shopify, I mean, they have really been trying to beef up their logistics side. You talk about the company taking part in the funding round with Flexport, their equity stake there. They also acquired a logistics startup, Deliver, and here they are talking about really trying to focus more on their core business, moving away from what the CEO describes as side quests. And to me, that just sort of points to just what so many companies are dealing with in this environment. Investors increasingly looking for companies to double down on more profitable businesses. If you think about Shopify, it really is about going back to that focus of how they started, which is software, or helping with software for a lot of these small businesses.
And it seems like this is something that investors wanted as well, due to the potential upside when it comes to margins. And we've seen this story before with investors really championing these strategic shifts, these cost cuts. And when it comes to layoffs, this is the second time in 10 months that Shopify has had to cut its workforce across tech. We saw this over-investment during the pandemic, where everyone really bet on that online boom, that e-commerce boom. And when that started to subside, unfortunately, that meant a lot of layoffs. But today for Shopify, those shares are soaring. And my play is pretty much the exact opposite. Paramount Global shares plummeting today, off 26% after the company missed earnings expectations and slashed its quarterly cash dividend to just 5 cents a share, down from the previous 24 cents. Streaming losses also continue to accelerate, with the media giant reporting a direct-to-consumer loss of $511 million versus the prior year period's $456 million. And if that wasn't enough, advertising revenues sank double digits within its TV media division, falling 11% year over year. Management does expect the ad market to improve in the back half of 2023, while subscription growth remained a bright spot in the quarter, with Paramount Plus subscribers hitting 60 million globally. Now, guys, a lot of these issues, particularly surrounding advertising weakness and those widening streaming losses, they're being felt across the industry, but Paramount still has a long way to go before it can reach that guidance of earnings growth and positive free cash flow in 2024.
Yeah, certainly. And Ali, when you take a look at these results that we just got from Paramount, you're going to think that that timeline is just going to be extended. There was a couple of analysts here weighing in, one from Wells Fargo, the team there, saying that it is a sign of a risk here to estimates. Obviously, no surprise. That's a general consensus at this point when you do see a cut to the dividend, but also going on to say that that initial expectation, I believe it was the end of right around 2024 is when they were hoping to get positive free cash flow, that is likely going to take a lot more time. We've seen this shift to direct to consumer be much more challenging and take a longer time than maybe a lot of these companies had initially anticipated. Paramount, clearly one of the names that's struggling in this environment with a weakening ad background, the ad market continuing to take longer to recover as well. We heard some positive momentum from some of the tech players earlier in the week, or over the last week or two, just about some of the recovery that we're seeing there. But it seems for the media plays, it's going to take an even longer time, Akiko.
Yeah, it's the weakening ad environment, but also Paramount, one of those companies that's sort of shifting the old and the new, and they're trying to find that right balance, right? If you think about their TV revenue, or their traditional TV revenue, that dropped about 8%. At the same time, as Ali just mentioned, they're still dealing with losses on the streaming side. They're trying to stop the losses by 2024, but it really is a very tricky dance they're trying to do there. Traditional TV obviously declining, but streaming not necessarily the most profitable, at least yet. Let's talk about my pick here. We're talking about Royal Caribbean. Better than expected quarterly results, lifting that stock up nearly 7%. The company's latest results signaling the travel boom, showing no signs of abating. Higher ticket prices helped offset higher fuel costs in the quarter, leading to a smaller than expected loss. And the cruise line said bookings in Q1 of this year outpaced 2019 levels by, in their words, a very wide margin. Royal Caribbean CFO Naftali Holtz telling Yahoo Finance earlier today that he's not too concerned about waning demand in the case of an economic downturn.
We continue to see very strong demand. We do not see any cracks in the consumer, and we are very, very focused on making sure we deliver on that experience. And as we look forward, that is what we're seeing. And if you kind of look a little bit longer term, cruise has been exceptionally well, even in very different economic environment. So we're very excited about what's ahead.
Well, the cruise liner now expects annual adjusted profit to come in around $4.40 to $4.80. That is a huge uptick from its earlier forecast. And Shana, we keep hearing about the big demand coming this summer, but really it has been ramping up for some time.
It has been, and it seems like, at least from these numbers, from what we've seen from even its competitors out there, that cruising is back and that it's accelerating at a quicker pace than we had initially anticipated. A couple of street commentary here. Stifel saying that this was a, quote, mic drop moment that we have been waiting for. True is saying that was the best quarterly cruise results versus expectations that we have seen in many years. So the street very encouraged by those booking trends that we've seen, and they're rebounding faster, which I'm surprised about, that it was exceeded in 2019 by a wide margin. I would still think a lot of people would be a little bit of a hesitancy here to go on a cruise given what happened in 2020.
Shauna, I remember there was a point people were getting trapped on cruises. No one wanted to go on any type of cruise. This is just such a crazy comeback. And like you said, we're seeing it across the board. All of those competitors, Carnival echoing very similar projections as well. So the cruise, that is the biggest comeback to me, I think. Don't call it a comeback, but it certainly is.
I don't think we're the demographic, by the way, Allie, because we keep saying, I'm still not going to get on a cruise.
Exactly.
I know, I'm too scared. I'm too scarred by what happened back in 2020, Allie, with what you're saying. Everyone being stuck on those cruises. All right, well, coming up as we move along here, the White House laying out its latest initiative for reducing the risk of AI. We've got the details on the other side of the break. Vice President Kamala Harris and other members of the Biden administration meeting with top tech executives at the White House today on the future of AI. The CEOs of Alphabet, OpenAI, Anthropic, and Microsoft were all in attendance. Yahoo Finance's Dan Howley is here with that story. Dan, we know the Biden administration is taking AI very seriously. It seems to be one of their priorities. What are we learning about the discussions that took place today?
Yeah, I mean, Kamala Harris, obviously, they're showing that this is an important topic for the White House. And just to give you an example, this is something that she had put out after meeting with them. She said, as I shared today with CEOs of companies at the forefront of American AI innovation, the private sector has an ethical, moral, and legal responsibility to ensure the safety and security of their products. And every company must comply with existing laws to protect the American people. I look forward to the follow through and follow up in the weeks to come. And just to give you an example of some of the moves that they're making, the National Science Foundation announced $140 million in funding to launch 7 National AI Research Institutes. That means there's now 25 of those institutes in the U.S. Anthropic, Google, Hugging Face, Microsoft, NVIDIA, and OpenAI and Stability AI all said that they would participate in a public evaluation of their systems at DEF CON. That's usually in Vegas. It's basically a kind of cybersecurity conference where if you take out your phone and you connect to public Wi-Fi, you're basically screwed. Someone there is going to hack you. So it's, the best of the best in the world of hacking. And then they said they'll also establish policies for federal departments and agencies on safeguarding Americans' rights and safeties and to empower agencies to responsibly leverage AI. So really, this is all about, trying to make sure that these companies are moving forward with AI in a responsible manner, and that when the government does implement it, it's in a responsible manner. There's obvious examples of AI being used in a negative light. If you look at what China's done with tracking individuals there, that's obviously an issue. But I think overall, this administration in particular is focusing so heavily on AI just because it's become such a big piece of the tech industry. And it's, as I kind of repeatedly say, AI has been around for a while. This is not brand new. But the generative AI aspect is the difference. And just the scale and the speed at which it's able to change the conversation, I think, is important. And so what we're going to probably see is more of this from not just the US government, but governments around the world to kind of get ahead, at least try to get ahead of any potential controversies in AI. Chances are they will not get ahead, but they're going to try.
They're going to try, and I guess that's what we can ask for at this point. But you're right, the explosion of really AI, it's certainly been around for some time, but getting a lot more attention ever since the launch of ChatGPT. And we'll be hearing from Reddit co-founder Alexis Ohanian later on in the program. And he actually said that it was the biggest development in technology in his career. So really speaks to how big and how serious and how, I guess, the potential here for AI going forward.
It really is, yeah.
All right, Hallie, thanks so much. Coming up next, we check in on the state of travel. Airbnb CEO Brian Chesky sits down with Akiko and Brad Smith. We've got that for you when we come back.
Well, Airbnb is rolling out some big changes to its platform. The company is adding more than 15 new features, including transparent checkout procedures, improved maps, and the launch of Airbnb Rooms. Yahoo Finance's Brad Smith, along with myself, spoke with CEO Brian Chesky on how all of these features play a key role in Airbnb's customer experience.
We are expecting 300 million guest arrivals this year, and we've been getting more feedback than ever. And we want people to have an amazing experience in Airbnb. But that means listening to customers, and we've been getting a lot of feedback, millions of customer service tickets, social media posts, and we've been interviewing guests and hosts. And we've been asking them a question: what annoys you about Airbnb? What can we do to make the experience even better? And they gave us so many different pieces of feedback. Things like, we want to make sure Airbnbs are affordable. When we check out, we don't have too many chores. We want to see the price up front. We want customer service to be very responsive. The other thing we saw is some big new opportunities. We're seeing more and more people stay longer on Airbnb. So we've made it more affordable to stay longer. We've got this really great dial to be able to search from a month to a year on Airbnb. And probably the most important thing we're announcing is Airbnb Rooms. Airbnb Rooms is an all new take on the idea that started it all. Airbnb Rooms gets us back to that founding ethos of sharing. And what it is basically just an idea that you stay in a room in someone's house, an extra guest room, while they're there. This is how we started. But the problem is that a lot of people have been telling us lately they don't feel comfortable staying with another person. We've heard this before. And so we said, well, what if we can develop a feature where you feel like you get to know the host before you book? And so we created this thing called the Host Passport. You can get to know the host. We verify their identity. You can learn about them. You can message them. So it's really just the idea of upgrading our profiles. And the reason someone would want to do this is the average price per night of an Airbnb room is $67 a night. And it's a great way to experience a city like local.
Brian, let me follow up on that point because as you have highlighted, a number of your summer releases really does point to that cost savings element. I mean, to what extent are you seeing travelers, those users on Airbnb, trading down their experiences in this environment?
Well, I mean, we are absolutely seeing a lot more interest in more affordable rooms in homes on Airbnb. Our average daily rate, our price per night, is pretty constant with a year ago. So I wouldn't say it's going down, but it's not going up anymore. And we think ultimately it's a good thing because I think affordability is a big part of Airbnb. And we've noticed that hotels are a bit more expensive. Some studies suggest in the United States hotels are about 10 to 15% more expensive than a year ago. And so we're just trying to make sure that we provide a great affordability. That's why we launched Airbnb Rooms. We now have opportunity to allow you to pay by bank if you have a monthly stay, which allows you to cut out the credit processing fees. There's a number of things we're doing to try to make Airbnb more affordable.
We've been speaking to a number of people within the travel sector. Everything points to real demand, significant demand, even going into the summer, even as those travelers get pinched. What are you seeing when you look ahead?
I think we're seeing that people are very interested in traveling, but they also want to make sure that the traveling options they have are more affordable than before. We also see a lot of people want to make international trips. A lot of people in the last 3 years have been isolated. They haven't felt comfortable crossing borders. I think people are finally getting more comfortable going to a foreign country. But again, if they do that, they're going to want to probably save more money than before, given inflation, other economic factors. Hence why Airbnb Rooms, we think, could be a really good option for a lot of people.
Brian, looking beyond Airbnb, we always like to talk to you about just where we're seeing the macro environment. You've got a pretty good pulse on what's happening in the Bay Area. And I wonder, as you've been seeing some of these regional banks collapse, particularly Silicon Valley Bank, what do you think that's done to the confidence of startups? A lot of them were banked there. And more broadly here, what does it mean for what was already a pretty fragile ecosystem?
I think that the regional banking crisis is probably honestly saying more about banking than Silicon Valley. I think that, the regional banks disproportionately affected early stage companies. Early stage companies' confidence were shaken for a week or two when it wasn't clear that people were going to have availability to the deposits within SVB. I think once those were backstopped, I think that kind of became an issue that people stopped worrying about. And so I think that it's a little bit a tale of two cities as far as tech. Really big companies and public companies, I think, have been under a lot of pressure. They don't have the multiples they used to have. They're experiencing a lot of layoffs. I think the same and maybe even worse are late stage private companies where their valuations might be 70% lower lower than the last round they raised money at, and a lot of companies might be underwater. They might be worth less than the amount of money that they raised. And of course, if an investor has a liquidation preference, that's a big problem for the founders. That being said, I think AI in particular has created so much excitement, and AI will allow you to be so much more productive that this feels in another way like, you know, the mid-90s, presumably. Of course, I was in middle school, high school back then, or perhaps the mid-2000s during the mobile revolution, the social networking revolution, where I think people are seeing so much opportunity. So I think that whatever economic problems we have in the early stage is going to be overshadowed by the excitement of AI.
We're hearing a lot of mentions right now about AI over the course of this earnings period, even over the course of 2023. It seems like it's having its blockchain type of moment where companies would just say it, see their stock prices rise, but it's a question of how's this actually going to be implemented. I mean, when even Coke is talking about generative AI, you're kind of like, okay, all right, guys, come on. But for Airbnb, a technology company, does this make any sense for integrating generative AI into any portion of the Airbnb operation or the experience for customers? Do you even think about that right now?
Yeah, I mean, let's just back up.
Yeah.
There's a reason there's tech buzzwords.
Sure.
Because once in a while, they're real. The computer was real. The internet was real. Mobile was real. The problem is if somebody talked about the metaverse, then they talked about crypto Web3, now they're talking about AI, there's a good chance they don't know about any of them. Because how could you be an expert in all three? But it turns out that AI, this time, this one's real. Now, using the buzzword is not going to change anything. It's going to change everyone's life. It's going to be like electricity. It's going to be something that we're all going to live with. It's a little hard to predict. I don't think that it's something that is a bandwagon you jump on. It's just something that's like the weather just changed. You just live in this new world where everything's going to evolve. A little hard to predict exactly what's going to happen. I think the nearest term impact it's going to have is it's going to make everyone in tech companies more productive. Software engineering will be more efficient because computer programming is a language. Sure. And now suddenly these tools can, in some ways, do development just as good as a person, in some cases better than the person. It can be great QA, it can be a co-pilot for them, and it could even like increase their productivity. So I think the main thing it's going to do is it's going to improve productivity. I think over the next couple of years, we're going to start to see really interesting applications go up. You only have a few big language models, like base models, you know, maybe like OpenAI. So the real question, the real economic opportunity is what can you build on top of them? What applications are now possible because of AI that weren't? So again, there's a lot of buzzwords, but once in a while, they become revolutions, and this is a revolution.
That was Airbnb CEO and co-founder Brian Chesky speaking to us earlier today. Shauna, it's interesting where he is calling this, what's happening with AI, a revolution. I did ask him about how he thinks it's going to disrupt the travel industry, and he said it really is going to be centered around digital operations like Airbnb. You know, what does it mean for airlines? A little too hard to predict right now, but he seems to really be looking ahead to integrating some of these models into Airbnb. You could argue some of that has already been integrated, although not in the form of AI that we've been talking about over the last several months.
Yeah, exactly. And Kiko, you and Brad were discussing it there with Brian, but it's really touching every single industry. Obviously, it could potentially really help, maybe even revolutionize the future of travel, but exactly how they integrate it, that is going to be interesting to watch. I was also surprised just in terms of demand, and I know we have heard it time and time again from nearly every CEO that we have spoken with over the last several weeks within the travel sector, but given the fact that we are in this higher rate environment, given the fact that we're headed for maybe a more significant slowdown, consumers continuing to spend, and they're spending at higher prices. Hotel prices up, just over 30% on a year-over-year basis. Brian talking about international trips, that being a bright spot. More and more people are looking to book internationally, very similar to what we heard from United CEO in terms of where they're seeing the most traction. So despite all these headwinds, people remain eager to travel.
They are eager to travel, but worth noting some of those changes that Airbnb announced with their summer release. It is about cost savings, too. He talked about rooms. He talked about partnering with Klarna so that you don't have to pay everything at once as a total. So they are sort of meeting the market even as they look at the demand.
Yeah, certainly are. I mean, you would think that would make a heck of a lot of sense, especially given the current environment. All right, well, that does it for today's trading day as we see the closing bell right now on Wall Street. Again, losses across the board. Dow closing off just shy of 300 points. We're looking at the S&P off about 0.7%, the Nasdaq off 0.5% here, as obviously the losses in the regional banking sector, a number of those banks under significant amount of pressure today and really dictating the action that we saw in the broader market. But let's take a look at some of those individual movers. And first up, the regional banks certainly hit hard, headlined by massive sell-offs that we saw in PacWest and also Western Alliance. The news out of PacWest that the company is exploring strategic options. We're looking at a loss of just about 51% over the last 2 days, 50% today alone. Western Alliance off nearly 40% today. And Kiko, there certainly are a lot of investor jitters there, just in terms of what could potentially happen with some of these bank plays within the smaller and mid-size banks here. Tim Coffey, though, of Janney Montgomery, telling us last hour that the fundamentals of the business, they're strong. When you take a look at deposit flows, the deposit numbers, they have certainly stabilized over the last 6 weeks.
Yeah, I was going to point to that. We saw that PacWest coming out with those numbers. Again, reiterating what we had heard on their earnings as well, saying deposits have stabilized at $28 billion. When you look at insured deposits, it makes up 75% of their deposits. So they've made the case here. Look, we are not SVB. We are not First Republic. This is a stable environment. And yet, to your point, jittery really is the word, at least within the markets. We saw Western Alliance having to come out today after their shares were halted, saying, we're not exploring a sale. So that's kind of the environment we're operating in right now. But let's talk about another stock that we saw today really getting hit, a downhill ride for Peloton. Shares there after reporting a larger than expected loss for the third quarter. The company did point to signs of progress as it topped subscriptions expectations, but the optimism didn't seem to sway investors today. That stock was down 13.5%, just roughly there. And Shauna, you know, this is a company that's in transition. We've talked about this for a while. This is not going to be an overnight turnaround. And I would argue that the signs of that turnaround are starting to take shape. You see connected fitness subscriptions growing, free cash flow losses declining, and then subscriptions accounting for about 60% of total revenue in the quarter. That to me is an interesting number, though, because remember early on in the days of Peloton, we used to talk a lot about their bikes, the hardware being really the big driver. Increasingly, we're talking about those subscriptions, and that's because that's going to make Peloton more stickier, which is really what they need right now during this time of transition.
They certainly do need that right now. CEO Barry McCarthy, when he was talking about those subscriptions, subscriber growth, he's saying, is our North Star goal here at Peloton, remains a challenge that we are fully embracing. We have seen Peloton make a number of initiatives, or take a number of initiatives that have certainly made sense. Some of their strategic partnerships that they have reached over the last several months, including that with Amazon, you would think really would bring a lot more awareness to their brand. But this turnaround strategy that McCarthy laid out just over a year ago is taking a lot more time than I think the street had initially anticipated that it would take. It wasn't too long ago that we were talking about maybe Peloton would be a takeover target. Those talks have kind of died down, but if things don't improve over the next couple of quarters, I wouldn't be too surprised if we start to hear a little bit more of talk about that. All right, let's also move on to another mover today, and that is Moderna, finishing the day strong after the company delivered a Q1 earnings beat, reiterated its full year guidance of a minimum of $5 billion in revenue from its COVID-19 vaccine. And certainly the stock has pulled back pretty significantly since the start of the year due to COVID demand concerns. Also mixed views on the pipeline and potential catalyst here for Moderna. Year to date, we're looking at losses of just about 25%. So this better than expected report here, Akiko, from the street, with shares rising 3%. Certainly something that analysts wanted to see.
Yeah, I mean, the declining demand or concerns around that with COVID. I never know whether we should say the pandemic is over because it is still out there, but that has always been the concern here. Moderna, you could argue, has really fared much better than some of its competitors in terms of keeping up that strength. But obviously, investors looking ahead to their pipeline as well to see what is beyond that. The stock at least getting a big pop on the day, given those numbers, up about 3% in the session. Well, another sign of the strength of the luxury consumer, Ferrari reporting better than expected first quarter results. That stock closing up roughly 5% on the day. We've got Praz Subramanian with the details. And Praz, what are we looking at there?
You said a strong start there for Ferrari, luxury consumer in focus here. Higher volume, richer product mix, higher prices, all working for Ferrari there, leading to an earnings beat, a revenue beat, and also a strong margin percentage here. CEO Benedetto Vigna calling out the 37.6% EBITDA margin. That's really pretty striking there. I mean, they're really making money here hand over fist in Q1. Also noting strong demand for the 296 hybrid supercar and that new Purosangue SUV. Now, this is Ferrari's first four-door, four-seater car. You're seeing the 296 right there. That's a beautiful car. But that Purosangue, they actually had to, it's going to cost over $400,000, believe it or not. And they had to actually close the order books because there was too much demand. They couldn't fulfill all those requests. They just opened it up again today. So you're seeing that they're trying to fulfill that heavy demand there, reopening those books. So looking ahead, they've opened the books. Their books are full through 2025. They reiterated their full year guidance. So good times there rolling for Ferrari as we enter 2023. And the question is, how long will that luxury consumer keep paying up and wanting these exclusive, high-performing cars?
Yeah, points to the divergence that we're seeing, especially with the strength still in the luxury space. Praz, thanks so much for that. Well, coming up, Warren Buffett's mistakes rarely make headlines. We're going to break down what they are and how you can avoid them. Stay tuned.
Breaking results out from Lyft here. You can see shares off just about 11% in extended trading. TQ revenue guidance coming in a bit light. That is really driving the action in after hours trading. Active riders coming in at 19.6 million. That was up nearly 10% on a year over year basis, slightly below what the street was looking for. But revenue per active rider, that was up 4% on a year over year basis, coming in above the street's expectations at $51.17. In terms of some of the Q1 numbers, Q1 sales also be coming in better than expected there. In this release, CFO Elaine Paul saying that rideshare ride growth accelerated here in this quarter on a year-over-year basis for the first time in nearly 2 years. But that light 2Q sales outlook is really what's weighing on shares here in extended trading. Akiko, with the stock off just about 15%.
Yeah, and Lyft inevitably compared against its rival Uber. It certainly looks like the numbers were better on Uber's part there, but it has been a long haul here when you think about the company having to go with that turnaround. I mean, what we've heard, if you want to take from Lyft, but also from Uber, ride hailing is starting to come back. People are returning to work. There are more use cases going up there, but Lyft's business simply just isn't as diversified as Uber. So when you think about where they are right now, it really does ride, no pun intended, largely on their business within the ride-hailing side. And that's why we are seeing that stock at least down nearly 14% right now in after hours.
Yeah, Nikiko, when you take a look at the fact that they reported fewer than expected active riders on the platform, this is certainly points to a sign that some of the lower fares, which we know has been the strategy here by Lyft in order to really remain competitive with Uber in an effort to win back some of that market share that they have lost over the past few years, that some of those efforts are falling short. We also know Lyft has been under a tremendous amount of pressure in order to cut costs. They have done so. They just recently announced a pretty substantial layoff there of their workforce. And in this report, Elaine Paul, the CFO, saying that we've moved decisively to cut our operating costs and we'll use the savings to pay for continued service level improvements in the near term. But you're right, they're up against Uber, which has a much more diversified business with Uber Eats, which has really been able to separate them from Lyft right now. Lyft certainly has an uphill battle. They have a new CEO in place who has made a number of changes since taking the helm, but similar to some of the other companies we talk about, that turnaround strategy, really regaining some of that momentum that they lost, might take a little bit more time.
Well, and then that transition that we've seen over the last year or so, which is going from high growth to really profitability, which is exactly what investors are looking for. Certainly not liking the numbers that have come out, at least for now. Well, Vice President Kamala Harris meeting with top tech CEOs today to discuss the promotion of responsible AI. Artificial intelligence is the talk of the town this quarter. Meta, Alphabet, Microsoft, and Amazon mentioning AI a total of 168 times in earnings calls. That's at least according to Business Insider. Apparently counted them all. My colleague Ali Garfinkel sat down with Alexis Ohanian, Reddit co-founder and 776 founder at the Milken Conference in LA. Ohanian discussing just how much time he commits to keeping up with AI. Take a listen.
As someone who lives in technology, who tries to stay on top of things, the first concession that one has to make is none of us can actually stay on top of this. I spend an hour every day just trying to keep up, just trying to learn, just trying to execute on whatever new breakthrough has happened while I was sleeping. And that's exciting, it's exhilarating as a technologist. We're finding ways. We've incorporated GPT into the operating system that we use to run our firm called Cerebro. It's making our lives easier. Our content creation is getting 10x, 50x more efficient. All the CEOs we're working with, even if they're not in AI companies, it is obvious that they're going to have to think through AI strategies, even if it's just to help make writing code more effective or customer support more efficient, all the way to like actual AI companies, which we are also investing in. So it's an exciting time. There is a ton of hype for sure, but there is a real significant technological shift, the likes of which, I started in 2005 when I began Reddit. I have not seen anything like this before in my career.
Really? So
it's
this is completely singular.
Bigger than the smartphone, bigger than broadband ubiquity, certainly bigger than social media. As much as it hurts my heart and ego, it's bigger than all those.
And one thing you've actually tweeted, said, is tweeting saying?
Yeah, tweeting saying. Not all the same.
Let's do it. Yeah, tweeting saying is that AI can enhance human stories.
Yeah.
Why?
I remember the moment that I was given a not 100% legal copy of Adobe Illustrator and Photoshop, the Adobe Suite. I had for years used either a Sharpie and paper to draw, create art, like the Reddit alien, right? I created that with a Sharpie on paper. Then I converted it into digital using a cracked copy of, I think it was Paint Shop Pro 5, to digitize it. And I did not know vector design existed, Adobe Illustrator. I had never seen real photo editing tools like Photoshop. And as soon as I got that software, I realized that my ability as a graphic designer, albeit not the most professional, but a good enough graphic designer, was going to increase 50x, 100x because of these tools, because of this software. What this presents, what AI presents, is that I have that same feeling, but the order of magnitude is so much bigger. And so many parts of work, and in particular knowledge work, work in front of or on a computer, is going to get so much more efficient. I was literally planning a vacation with my wife yesterday using ChatGPT I had it act as a premium concierge travel agent, which also hurts my heart a bit. My father has been a travel agent his entire life. Thankfully, he just retired. I even started a travel search website called Hitmonk. My dad's travel agency outlived my startup. Again, it hurt the ego, but he won. But what GPT
You're taking a lot of blows to the ego here, Alexis.
It's fine. It's being in tech is very humbling, right? You think you've built a great idea, and then you come to find out that the next big thing is just around the corner. To see the ways this is leveling up, the delight that it produces, and this is still in the jankiest form, right? The user experience is only going to get better, but it's undeniable. This is going to have a big impact on many sectors.
And for you, I want to switch gears to space.
Sure, there's one.
Yes, I know.
Yes.
We just did that transition
Let's
right
go.
there. Why space? It's a pretty high stakes area. Rockets
It is.
blow up.
It is, but it's all, look, it is certainly all in the name of human progress, which is something I'd like to believe we can all get behind. That is one area where, these advancements in AI are definitely going to help, and there's still a lot of very real physical work that has to get done. There's a lot of capital investment required. That is a sector that's certainly going to be boosted by this progress, but it's one that still requires a lot of fortitude and a lot of grit and a lot of talented humans to do this work. And so at 776, we're a generalist fund, but we've been the first check in a couple of space tech companies now. Stoke, which is doing reusable rockets, they've been on time and under budget for every one of their tests and launches so far. They're doing incredibly well. Another one, Astroforge, even earlier stage right now, but they aspire to one day both recover and refine minerals on asteroids and bring them back to Earth. And so rare earth metals we normally have to dig up in pretty unsustainable ways on the planet, we can one day, I believe, do from space, literally from mining asteroids. And so these help us back home, right? Both of these companies are doing great work that, yes, is technically space tech and will help us become a civilization and a species that is multi-planetary. But the focus here is still, how do we make life sustainable and viable on Earth? And I think it's important. This is the stuff that gets me out of bed, fired up as an investor, because I feel like this is bigger than just finding potentially great businesses, but also good for society.
Now, the difference between rockets as an investment and sports teams. Walk me through it.
Look, we're generalists, okay? And I've been very fortunate being the primary owner of Angel City FC. That was an investment back in 2019. You can check the receipts. There were a lot of people who said I was going to lose all of my money in women's football. And I save all their replies, because now when we hit milestones, we have more season ticket holders than the LA Galaxy and the LA Kings, great franchises, but we're 2 years old. We have more season ticket holders, and so when we hit those milestones, I like taking those screenshots of the tweets from 4 years ago, tweeting them out and tagging the guys, it's always guys, who said no one cared about women's sports. Our job at 776 is to be early and right in areas and sectors where we think there's outsized returns, get an ownership stake that we know can return capital to investors, and then work with those founders for a decade. So whether it is sports, whether it is space tech, whether it is AI and software, we just want to do our best to build the best network of founders to pull from, to take pitches from, and then help build big businesses.
Thanks, Ali Garfinkel, and of course, Reddit co-founder and 776 founder Alexis Ohanian. Coming up, we are tracking the earnings here. We are set to break down the numbers from Block, which was just released a few minutes ago. Apple, that's coming up at 4:30 p.m. Eastern Time. We'll be right back with those numbers.
Well, the market is digesting the Fed's 10th consecutive rate hike. Fed Chair Jerome Powell warning of headwinds from tighter credit conditions, especially in the face of the banking crisis. But overall, Powell did not appear too concerned, saying the system is, quote, sound and resilient. Investors don't seem to agree with Powell. Shares of PacWest plummeting today in the session, down 50% after the bank confirmed it is in fact exploring sales of strategic assets. Western Alliance shares also sinking. Trading was halted earlier today. For more on the crisis and how it will impact small businesses, we're joined by Burton Goldfield, TriNet CEO and president. It's good to talk to you today. I guess there is a debate, first of all, whether in fact we are in the middle of some sort of banking crisis. But when you think about the higher rate environment, what has that meant for you as a small business owner?
So for me, which represent over 22,000 small businesses in America, their hurdle rate is higher. But great businesses are being funded, and we are seeing a record level of innovation and success with many of the small businesses we serve.
But given the fact that we will likely see, if not, we have already started to see tighter lending conditions, to what extent do you think that's going to hold back growth in the sector?
So overall, what I am seeing is a fairly bifurcated environment. I'm seeing biotech companies that are successful getting additional funding. I am seeing software companies getting additional funding. But at the end of the day, you need a business plan, you need resiliency, and you need to show success in the short term.
What do you mean when you say the hurdle is higher?
Meaning that the path to profitability, the time to profitability, the ability to generate real revenues is shorter because the cost of capital is higher. There's no question about that.
Burton, do you think we could potentially see more bankruptcies? I mean, it would likely to be that we would see more bankruptcies within small business because of the challenging environment.
Certainly that's a possibility. I don't predict the future, but in the 22,000 businesses that we're serving, and we have served for almost 30 years, we are not seeing a spike in bankruptcies like we did in the 2008 and 2009 years.
How do you think this changes the way that small businesses operate now? I mean, there's certainly a lot of risks that have popped up over the last several months that maybe a lot of small businesses didn't really foresee. What are you hearing about how they're going about shifting things up?
So resiliency is the key, and your point is correct. The changes are coming fast and furious with the banking issues, COVID, PPP loans, all of the things that small businesses face, including remote work situations. Resiliency takes its form in people, processes, and systems, and the companies that have people who are resilient and focused on results, processes that can handle change quickly, and systems that can support those changes are succeeding. I am very optimistic about what the next 6 to 12 months has for the small and medium business market in the U.S. And I believe over the longer term, nobody I know believes that technology, professional services, biotech won't grow and prosper in America over the next few years.
Well, Burton, given that growth that you're expecting to see among small businesses, what about the labor force? Certainly labor shortages has been something that a number of business owners have been having a tough time dealing with. Are they able, the business owners that you've been speaking with, are they able to find the workers that they need and attract the top talent, and how so?
So they need to attract the top talent by having the right culture, by having the right mission. But frankly speaking, the larger companies have laid off great people, and I am seeing the small, medium businesses snap up the people they've coveted for the last 2 years.
All right, Burton Goldfield, we'll leave it there. Thanks so much for joining us, CEO and president of TriNet. Coming up, we are counting down to Berkshire Hathaway's annual meeting. We'll give you a look at what you need to know ahead of that when we come back.
Warren Buffett's Berkshire Hathaway is hosting its annual meeting this weekend. Tens of thousands of shareholders are expected to travel to hear the Oracle of Omaha's ideas on all things investing. Buffett's investing success has always been accompanied by not just his characteristic humor, but also his humility. The billionaire has admitted he's not perfect and has pointed out his own missteps over the years and lessons learned from them. Our next guest says investors can learn a lot from Buffett. He is Berkshire Hathaway shareholder and is already out in Omaha. Thomas Russo, managing partner at Gardner, Russo and Quinn. Thomas, it's good to talk to you today. You know, we always talk about the big successes for Warren Buffett, but you've said there's a lot to learn from some of the mistakes that he's made, particularly when it comes to his investments right at the heart of the pandemic in 2020.
Well, I must say, thank you for the chance to visit. I must say, it's very hard to find any mistakes that Warren's made that had consequence. I think several things changed during the midst of COVID. For instance, the airline industry investment, which was designed for one world, changed dramatically when airplanes stopped flying, and so the response was to adjust the portfolio to reflect that. And yet, there's so many ways in which Warren has to make money. One has to remember that a lot of the investment success is under the water. It's like the paddling duck. Warren invests tens of billions of dollars a year in the railroad business, in the Mid-American energy business, in the National Indemnity Insurance business. So much of what Warren does to deploy capital is in private companies that are partially held or fully held, in addition to the equity market and other financial services that he works on. Truly remarkable.
So, Tom, then what are some of the biggest lessons then that we could learn or other investors can learn from some of those moves that Buffett has made, not only in 2020, but in any time that he has run up against a challenging environment?
I think the number one thing to keep in mind that Warren Buffett shared with my business group over almost 40 years ago was that, as he said, you can't make a good deal with a bad person. He stressed even then the notion of character and the notion of agency cost. And the agency cost is what happens when your agent, Warren is our agent as he manages funds on behalf of all of us public shareholders, he has to pledge to give us a fair deal. It's hard enough to make money alone, but to do so, attempt to do so in the face of an agent who's gone awry is doubly hard. So number one, I'd say, was don't make a deal with a bad person. Number two was take advantage of the government's tax break. The only break they give investors is the non-taxation of unrealized gains, and take advantage of it, which drives the third point, which is you have to be comfortable investing for the longest term if you're going to maximize the benefit of reinvestment. And reinvestment being required to have tax-deferred wealth. So 3 words I start with. One is agency cost, one is tax-mindedness, and one is, that's it.
So, Thomas, you're already in Omaha. You've got hundreds of people headed your way. What is your expectation for the annual meeting? And more importantly, what are you hoping to hear or looking to hear from Warren Buffett and Charlie Munger?
I think that the timing of this couldn't be better. We've been given the most extraordinary primer on banking finance that you could have hoped for. It was probably more than you actually hoped for. But so there's still going to be, I think, quite a lot of discussion around that, which I welcome.
Thomas Russo joining us there. Thank you so much. Appreciate your insights today. Thanks so much.
All right, Akiko, let's get to Apple earnings. They're crossing the wires right now. We're looking at shares move higher here in extended trading, a beat on both the top and bottom lines here for Apple. You are looking at a gain of just around 1.5%. EPS coming in at $1.52. The estimate was for $1.43. Also, revenue coming in better than expected, $94.84 billion. The estimate was for $92.6 billion. The company also authorizing an increase of up to $90 billion to its share buyback program, also boosting its dividend to 24 cents per share. Digging into some of these numbers here, iPhone revenue also coming in better than what the street was looking for at $51.3 billion. Estimate was for just over 48.97 billion. China revenue also beating the street's expectations, 17.81 billion. One area that the company did miss, although it was a slight miss here, was its services revenue. That coming in just a bit light, 20.91 billion. Estimate was for 21.11 billion here, but again, a beat here for Apple on both the top and bottom line, also authorizing an increase of up to $90 billion to its share buyback program, boosting its dividend to 24 cents a share. You're looking at gains of just about 2%.
Yeah, Shauna, when you think about the strength in the numbers that we're getting on iPhone sales, certainly points to the momentum the company continues there with iPhones being a big driver. But when you look at the broader numbers here, overall sales fell for the second quarter in a row. You pointed to some of the challenges in the services side. But again, interesting to hear, or it's going to be interesting to hear how Tim Cook tries to spin that one, because there's certainly, while Apple, you could argue among all the tech names, has shown the greatest strength here, even in the face of some of these financial conditions, there are fears about maybe how consumers are going to continue to pull back here in their spending, discretionary spending, as they continue to get pinched by higher prices.
Yeah, certainly. When you take a look at that services revenue, it was a miss from what the street was expecting, but it's still an all-time record, 20.91 billion. So certainly Apple trending in that right direction. But you're right there, the iPhone sales number of revenue there coming in 51.33 billion. We know Apple had run into many supply issues in its previous quarter. A lot of analysts on the street and really investors were closely watching that number. So the fact that that came in better than expected pointed to strong demand for its latest model, the 14. Obviously, that's a positive here for Apple at this time.
Yeah, and also looking at the international side of things, of course, we like to look at Apple's China business there. They saw a decline there as well, $17.8 billion, what we're looking at in terms of greater China business. But that's going to be a story that I think a lot of investors are going to want to follow here, because really when you think about where that growth story is, some would argue that's kind of just in the beginning as China tries to bounce back from those very stringent COVID lockdowns, and they've eased up over the last several months. Going to be interesting to hear any commentary on that one, because it has been a big driver for Apple in the past and has the potential to really do that as Apple sees more slowdowns, at least in some of these Western countries.
All right, well, coming up, we'll talk about how could the writer's strike impact the earnings for Warner Brothers Discovery. We're going to preview what you need to watch from the streaming giant. And of course, we're going to dig deeper into these Apple's results with shares moving higher in extended trading. We'll be right back.
Warner Brothers Discovery is set to report its first quarter earnings before the bell on Friday. Let's bring in Yahoo Finance reporter Alexander Canal, who is looking at a preview. What can investors expect?
Hi, Kiko. Well, this is going to be an important earnings report ahead of that HBO Max Discovery Plus streaming relaunch that is dubbed Max, set to debut on May 23rd. So investors will be keeping a close eye on those direct-to-consumer losses, whether or not we'll see some easing there. In the fourth quarter, WBD did report a direct-to-consumer loss of $217 million, although that was a $511 million improvement over last year. The company estimated its streaming division will break even by next year before hitting profitability in 2 years. And on that last earnings call, David Zaslav very adamant that the company is in a good place, that the bulk of its restructuring is behind it, and that they are moving forward as one company. A few other key metrics to look out for. According to Bloomberg consensus data, revenue expected to come in at $10.73 billion, a loss per share of 5 cents, and subscriber net additions expected to come in at 911,000. Now, on top of that competitive streaming market, the company has also struggled with a very unfavorable ad environment. And we saw that happen earlier today with Paramount. They struggled with advertising as well. We saw network revenue tumble 17% in the fourth quarter, 14% excluding foreign exchange. So keep an eye on potential double-digit declines on the revenue side as those headwinds and macro concerns continue. However, I will say on the street, they have been rewarding this company, as you can see on your screen, a heck of a lot more buys than sells. Analysts have really praised Warner Brothers' turnaround plan and their ability to cut costs. Shares are up about 30% year to date. We'll see if the company can keep up that momentum tomorrow morning.
And Allie, while we're talking about the company's performance in the first quarter, if you talk about what's happening right now, you've got all projects halted essentially because of a writer's strike that's gone into effect since Monday. How big of an impact is that likely to have on Warner Brothers?
Well, obviously, there's not going to be an impact on this earnings report, but I think moving forward, all of these companies are really taking a look at what's going on in Hollywood, what's happening with this writer's strike, and how that could impact them down the line. David Zaslav, he did specifically address the writer's strike during that April HBO Max Discovery Plus streaming event. He said they have enough content banked in the can that they should be okay. It's also a company that deals with sports very heavily and reality and unscripted content. However, we did hear from Bob Bakish, the Paramount CEO, earlier this morning, who said that the longer this goes on, the more likely that it will impact their financials and could potentially diminish revenue. And that's something I think we'll see across the board. I can guarantee you David Zaslav is going to be asked about the writer's strike on that earnings call tomorrow, but this is a story that's just going to continue. And I think both sides, they want to find a solution as quickly as possible. However, clearly right now in the negotiations, there's a big gap on the wants and the needs here. So it's something that we're going to continue to track.
Okay, keeping you busy there. Allie Canal, thanks so much for that. Well, Block's first quarter earnings are out now. The tech company reported a beat on both the top and bottom lines. Revenue coming in at just under $5 billion, topping the $4.5 billion estimate, while an EPS of 40 cents tops the estimate of 32 cents. Block currently trading higher in after hours, getting a bit of a pop. The stock now up more than 2%. Well, coming up, more on the latest from Apple earnings on the other side.
Apple here trading is higher in extended trading, up nearly 1% after beating on both the top and bottom lines. A stronger than expected results driven by a boost in iPhone sales. iPhone sales also topping the street's estimates. Apple also authorizing $90 billion in share buybacks and boosting its dividend to 24 cents a share. We want to bring in Tom Forte. He's D.A. Davidson Managing Director. Tom, it's good to see you. So what's your first take at this report that was just released?
So my first take is that the results are favorable as we anticipated, to the extent that the reopening in China had Apple well positioned from a supply chain standpoint and a demand standpoint when you think about 10% of revenues are to Chinese consumers. I also think they got an added boost from foreign exchange rates when you think about how, when compared to the December quarter, the US dollar weakened against the pound, the euro, and the yen. So good results from Apple, which is very encouraging.
On that international picture there, Tom, when you talk about the Chinese market, I mean, how much of this is kind of the tip of the iceberg? How do you see this momentum carrying into the current quarter, just given that how much time has passed since China has essentially switched or shifted their COVID policy?
I think the good news is that the March quarter results suggest that the challenges they had from a supply chain standpoint and from a demand standpoint, that those sales shifted into the March quarter instead of being lost entirely. So I do think that there's another opportunity for more of those sales to be shifted into the June quarter, the next fiscal quarter for Apple. So I think there could be additional momentum on the Chinese reopening trade for Apple.
Tom, when it comes to some of the moves that Apple has made over the last several weeks and really months, diversifying its manufacturing footprint, really trying to move some of its production, more of its production out of China, what do you make of that move there? And we talk about a potential catalyst here for Apple going forward, or what could really maintain the momentum that we've seen since the start of the year. How big of a boost do you think could potentially be provided by India?
Yeah, so the good news for Apple is that they have the playbook for India to some large degree, which is China. So long term, we're the company to be able to rely on India significantly for its supply chain to a much greater extent than it does today, and generate 5 to 10% of sales to consumers in India. That would be a tremendous success. I do think, though, that's going to take a very long time. One, to switch their supply chain to be less dependent on China. And two, on a relative basis, there's more consumers in China with higher discretionary income today than India. So basically, they need the emerging market of India to grow so more consumers there can afford Apple's products.
Tom, let me push back on that a bit, because we have heard that argument before about the playbook from China translating to the playbook in India. The reality is, over the years, that just hasn't necessarily materialized. What has changed this time around that gives you more optimism in the Indian market? Because Apple's been trying for years to compete in a big way.
So I would agree to the extent that Apple is yet to come up with an inexpensive iPhone to penetrate the market in India, which is very dominated by Android devices. What has changed, I think, is that Apple realizes that it has to diversify its supply chain so it's less dependent on China. I think that's what's changed. So I'd argue that maybe there's a greater necessity here. And because of the greater necessity, Apple will place more of an emphasis on it. And then over time, that will lead to ultimate success.
Tom, why don't you think we're seeing more of a reaction in shares after hours? Because when you take a look at the stock right now, it's pretty muted, given the fact that it beat on almost, not all, but almost all categories here.
So an argument can be made that the good news was already in the shares, to the extent that if you look at the performance of Apple stock in the calendar first quarter, it had one of its best quarters in many years. Now, I think that was a combination of the reopening trade in China and also expectations that the Federal Reserve is at or near an end in raising interest rates. So I think you could argue that the muted reaction after hours is a reflection of the strong performance year to date in shares of Apple.
Tom, I'm curious to get your take on Apple and this high savings yield account. I mean, we have heard that initial push here reportedly attracted $1 billion in deposits. I mean, I realize this is a long-term play, but really, what is the play for Apple, and how significant is this banking business going to be?
So it's something I've been thinking about a lot, and I will admit that I was initially too pessimistic on Apple Pay. I didn't think that Apple Pay would become so prevalent as it is today. So I think I had the same initial reaction to this very high savings rate account that Apple's offering. The suggestion that there's $1 billion already in those accounts is very encouraging. But I do look in that case for more information on the earnings call to find out what is the strategy and why is it so important to offer such a high rate on these savings accounts, and what will that, how will that help Apple? I know they want to become the digital wallet, but is it really necessary to have such a high interest rate to advance that effort? And that's unclear to me right now.
Tom, what do you think about the fact that Apple just has been pretty light on the product side as of late? That has been the criticism that people that have been neutral on the stock, bearish on the stock, have been pointing to. How critical is it, do you think, that Apple really ramps up that side of the business, the product side, with new innovation and quickly?
I do think it's important from a long-term standpoint. They've benefited tremendously from the 5G network upgrade. And an argument could be made they've only had marginal improvements for the last couple generations of iPhones. I am of the belief that at some point in time, they will expand their product lineup to include an augmented reality, virtual reality product, and then further down the road, automobile, a self-driving automobile. And I think at some point in time, the stock's going to need incremental new products to sustain revenue growth, to sustain the stock's performance. So I do think that's important over the long term.
Tom, always good to talk to you and get your take. Tom Forte with D.A. Davidson joining us there on Apple. And be sure to tune in later as our very own Brad Smith and Diane King Hall dive into the numbers after the call. That is around 6 p.m. Eastern tonight. Get it over to Shauna for some after hours movers.
All right, Akiko, let's take a look at 4 movers here after hours, all to do with earnings. We have Lyft, Block, DoorDash, and Coinbase. Kicking it off with Lyft, we're looking at losses of just about 12% in extended trading. The company's guidance for the current quarter, second quarter, coming in a bit light. Also, active riders for its first quarter coming in below the street's expectations at 19.6 million, still below the levels that we saw pre-pandemic, and that was at just around 22.9 million riders. So when you take into account shares off just about 14% in extended trading year to date ahead of these results, it was off just about 3% over the last year. We know Lyft has been under tremendous amount of pressure with shares off just about 50%. Moving on to Block here in extended trading, that stock up nearly 3%. Now the company beating on both the top and bottom lines. Q1 gross payment volume coming in better than expected, 51.1 billion. The company also boosting its full year outlook on the jump that it's seeing in its Cash App here. So extended trading up just about 2% over the past year, though. Block has been one of the names that has just been under pressure, most recently also year to date. Year to date, we're looking at losses of just about 4% over the last year, losses of 43%. Moving on to DoorDash, more people are ordering delivery. That certainly is apparent here from these most recent results. Revenue coming in better than expected at just over $2 billion. That's up 40% on a year-over-year basis. Q1 orders also better than expected, 512 million in extended trading. We're looking at gains of just about 6%. And this stock has certainly been off to a strong start this year with gains of nearly 30%. And wrapping it out with Coinbase. Now that stock has been a bit of a different story over the past year. Year to date, it's regained some of that momentum, but in extended trading, it's actually moving to the upside, up just about 7%. Revenue did beat. The company also reporting a narrower than expected quarterly loss. So on the top and bottom lines in relation to what the street was expecting, these numbers don't look too bad. But on a year-over-year basis, we're looking at revenue off 34% from what it was just a year ago. Transaction revenue off 63%. And also just in terms of the company warning that it does expect a sequential decline in subscription revenue, something that could be potentially worrisome here for the company. Year to date, we've regained some of our momentum with shares up just about 39% over the past year, still looking at losses of about 62%, Akiko.
62%. That is still a very steep loss there. Coinbase, of course, also facing a lot of challenges on the regulation front. We were just talking yesterday about the company launching that international exchange, or a few days ago, about launching that international exchange, largely to try and generate more business as they face some pressure from the SEC here in the U.S. Well, it is closing time here at Yahoo Finance. Let's get you caught up on some of the biggest headlines of the day. Regional banks tumbling again today. Among them, Pacific Western, which says in a statement it has explored potential asset sales, adding it has been approached by several potential partners and investors. And shares of First Horizon sank after its merger agreement with TD Bank was scrapped because of regulatory hurdles. The ongoing turmoil with regional banks rattled investors, with all three of the major indices closing lower. Shauna.
And Apple releasing its second quarter results after the market closed. The tech giant beating on both the top and bottom lines. It also announced it would boost its share buyback plan by up to $90 billion. We're looking at gains of just about 1% in extended trading.
And finally, Johnson & Johnson spinoff Kenvue started trading today. It is the largest IPO since 2021. Kenvue brands include such household names like Tylenol, Band-Aid, and Listerine. Shares opened at $25.53 a share. You see it getting a big pop there. And that opening number right above that initial price of $22 a share, it ended the day more than 20% higher, closing at $26.90 a share.
Make sure you stay tuned here to Yahoo Finance. Coming up later on tonight, Brad Smith and Diane King Hall, they will dive into Apple's latest earnings report in today's edition of After the Call. That all starts once the call wraps up around 6 p.m. Eastern time tonight. That does it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here tomorrow afternoon as we count down to the closing bell. Have a good night.